This is our Forex blog for June 7th, 2012, and I like to go over our easy three-step Forex trading rules real quick. As you've seen in previous blog videos, I've also gone over this. You can pause this right now and read it as well. So step one is use our currency meter and find the strongest and weakest currencies. You want to buy the strongest currency versus the weak, and you want to sell the weakest currencies versus the strong. So in other words, you're focusing on buying the strongest currencies and selling the weakest currencies. So step two is wait. Too many traders are impatient. They sit down, they want to find a trade. They can't wait to get into the market and make money. The flip shot of that is without patience, without waiting for good, high probability, low risk trades, waiting for trades that have a good chance of making 2 times or 3 times more profit than what your risk is. Just taking any average trade is not going to give you what you want. Just like marrying the first woman you date typically is not the smartest idea either. So you need patience and discipline. So again, you want to buy the strongest currencies, focus on buying the strongest currencies from the currency meter, wait for a buy signal to show up on your chart. When the price goes 1 or 2 pips over the high, previous bar's high, you get in. Or if you're a more conservative trader or don't 100% believe in the trade, you think it might pull back a little bit more before it goes back in the direction of the trend, then wait for the trailing stop to get hit and flip down below price and turn from red to green. Then you buy. So for the weak currencies, you want to wait for a sell signal, which shows up above the bar's high. And then you want to wait for the price to go 1 pip below the previous bar's low. Or if you're a more conservative trader or you think it might continue a little bit further before it reverses, wait for the trailing stop to get hit and flip up above price and turn from green to red and sell. So step 3 is exits. Inexperienced traders, those with smaller accounts, maybe 50,000 or less, 25,000 or less, should use our trailing stops for exits. Most of the time, if you're watching our software, you might find 2 or 3 trades at a time, so you don't have enough leverage to have bigger positions on each one. And some people are using MetaTrader, which makes it hard to exit half of your trade. So in other words, if you use MetaTrader, you might want to put 2 trades on with half the size that you want to trade. In other words, if you're going to trade 1 lot and you're buying, you'd buy half a lot, and then you could exit and close one of the positions at the rules below. Professional traders and or those with bigger accounts should exit half of the trade using the rules. If price stalls at the next support for sell trades or resistance for buy trades, exit half the position. Here's the key areas of support resistance in order of importance. Fibonacci profit targets and or Fibonacci retracements, previous month's high or low, monthly pivots, previous week's high or low, weekly pivots, previous day's high and low, and daily pivots. Those are the order that I would classify them. The market's more likely to go through some of the lesser areas of support resistance than it is the more strong support resistance. So if you're a bigger trader or a professional trader, you want to exit half if the price stalls. If it shoots right through it, then hang on. And then you want to exit the remaining part of your trade above or below the 1.618 fib target or when the trailing stop gets hit. And markets rarely ever go beyond the 2.0 fib level. So hopefully I can find an example of that today. It might go 5 to 15, maybe 25 pips, but it almost always reverses, and usually almost to the pip at the 2.0 fib level. Keep in mind, fib levels are based on the previous swing. If you have a tiny 15 pip swing, then it's much more likely to go through the 2.0 level. If the previous swing was 50 pips, then the 2.0 level would be another 50 pips up, which is a very big distance away and more likely to hold as the next support resistance area. So here's our currency meter that you want to use to find the strongest and weakest currencies. The real-time strength or weakness is at the top in histogram form. This is made up of 5 of our best statistical trend tools. 3 of them measure the percentage trending up and down, and the other 2 measure the intensity of that trend. So anytime it's at or above the 80 level in red, it's extremely strong. Underneath that, we have the 15-minute trend, hourly trend, daily, weekly, and monthly. So you can see the yen was extremely weak today. Let's first also bring this up. This is our sortable range-based currency meter. So if you sort this from strongest to weak, you will find the ones that are most moving up and down now. The pound was the strongest earlier, and it still is, and the yen is still, the weakest. So the pound was the one you wanted to be buying against the yen or the Australian. Okay, so we're looking to buy the pound yen. The pound Australian is not a currency that I leave running overnight, and also the Australian, later in the day, it goes weak, but most of the daily, weekly, monthly trend is pretty strong, and you don't know if a currency is going to be this weak for this long. Typically, if the longer term trend is up, you might have 1 to 3 hours of weakness, and then some severe strength will come back. So it's a lower odds trade, even though today it would have worked. So let's look at the pound yen chart. So looking at the pound yen chart, you can see you're looking for buy signals, and usually you're better off waiting for a little bit of a pullback. If you see these buy signals right here and it goes 1 pip above the bar's high at 18, you can see in this case you would have got stopped out. If you waited for the trailing stop to trigger, you'd be in this trade right here at 17, and notice you never get stopped out until the end of the move right here at 39. So in this case, you have been in this at 17 out at 39 for a 20 pip profit. Buy signal right here, there's one where you could have got in when it went 1 pip above the bar's high at 26 versus 29. So you paid up 3 pips to possibly avoid another losing trade or getting in too early. In this case, the market immediately went up from 27 all the way to 55. You just made about 28 pips. Now it's up to you by looking at the currency meter and all the time frame trends, whether you want to take trades when they go above the white 2.0 band. Sometimes I'll take them, sometimes I don't. In this case, this is off the chart strong. It's one of the strongest 15 and hourly trends. The daily trend is already up, the weekly trend's up. I personally don't care about the monthly trend. I only have it on the chart to see what it is, and sometimes I might trade more lots or less lots depending on it, but it doesn't influence my decision to take the trade or not. So, this one pulled back, went up, pulled back, went sideways. Some of our entry methods are very hard to code up into programmatic methods, but one of our methods is a rectangle pattern. So you can see it right here. It breaks out above here, and the trailing stop coincidentally gets hit at the same time, and you would have been out of this trade right here around 66 and at 46 for another 20 pips. And if you're a longer term trader, you might just draw your fibs on the first wave up and then kind of wait to exit somewhere up near the first or second fib target. Notice the second fib target up here, the 2.0 level. Remember earlier I said the market rarely goes beyond the 2.0 level, and you can perfectly see that today. It went maybe a pip beyond it, up here around 25 to 27, and then pulled back over 50 pips. I actually scaled into a trade here, got in and got out during this move here, got in again right here, and pretty much got out of most of my trade in this area right here. And later on, when it came back down to the 75, 80 area, I got out of the rest of the half of my trade. It took a long time. You can see anytime a market makes a big move like this, it almost always pulls back 38%, and that's why my 70, 75 area was what I was looking for. I have it scroll back right now. You can see basically once this thing fell off the second time, it continued. What I should have done, and a lot of times I do looking for counter trend trades, the green areas are almost always the end of the move. So if you want to get into what appears to be a risky trade, it's not really a risky trade because these 3.0 levels are statistically based. And in my experience, about 80-85% of the time, you're going to get a pullback. If you scale into a trade, usually you can come back 7 to 12 pips, allowing you to get out of your scaled-in trade near break-even. I scale in progressively, which, for an example, might be selling 1 lot, selling 1.5 lots, or selling 2 lots, depending on how much of a spike it makes. I always draw my fib levels. I always have my maximum price level. 124.50 is the highest I thought this would go. It only went up to 124.30, so I didn't really get into a super huge position because I was planning for it to spike up again, put a big position on, and obviously yank my position price closer to the 124.50 area, but it never happened. But that's okay. I mean, the market sometimes does that. Sometimes it shoots beyond what you think the maximum it can go. You can see this was just incredibly strong, but I made money selling it, mainly because I wasn't trading earlier in the day when some of the easier and lower risk trades were, like right here and here. I missed those trades. Now as I scroll back the dollar, you can see the dollar is also very weak from 7 to 9.30. So the pound dollar also made sense to buy during that time. Let's scroll back and look at it. Here's 7 o'clock or so, 7:30. You had a buy signal right here. If you waited for the trailing stop to get in here at 26, you're out at 53. There was not a pullback right here just because of the monthly trend was down. Some of our signals, when they're near the 2.0 band, they look at that. I might have an option for people to see riskier trades or not. Anytime the market pulls back 2 or 3 bars, goes up, then goes 3 or 4 bars back, and then up, it almost always reverses when it has this kind of strength. This is kind of a pattern that I look for myself. You know, and a lot of people, when they see a currency this strong, just buy and sell whenever the trailing stop gets hit. In at 43, out at 59, in at 60, out at 71. You know, I would never buy up here near the 3.0 green level. And in fact, if you wanted to look for counter trend trades, short at 71, out at 75, small loss. Short here at 82, out at 79. And you can see some of the later ones really worked out. I didn't take these shorts. 92 sell, out at 89, not much profit, and here at 84. This one kind of went down in waves and not as aggressively as most of the time they do. Anytime a currency is up this much, usually what I do is I wait for the first wave down, draw my fibs, and exit at the first or second fib target. You can see the first fib target had shot through the second one. And again, markets rarely go beyond the 2.0 level, which you can see touched it to the pip and then shot from 40 all the way back up to 80. So if you do hang on to a trade past the 1.618, if it goes to the 2.0 and you're still thinking it's going to continue down, notice this does not have that much statistical strength or weakness, especially compared to the strength before. Don't be a fool. Get out somewhere between the 1.618 and 2.0. It's more of a gut feel. This one kind of went down and kind of went sideways with no weakness. It's going to go back up. This is one heck of a strong trend, as was the pound yen. So don't be greedy. Take your if you did short it up here somewhere around 90 or 85, wait for a 2-wave pullback, get out somewhere near 50. You made 30, 35 pips on a counter trend trade.